do like to start off every show with kind of a summary of what was happening in the market this week. There's a lot going on. It's incredible. I mean, there's a pretty good sized list of things to talk about almost every week with all the activity that's happening with tariffs and what have you too. So let's start off just with the chart. Things are pretty good in the market, and they really are. We'll talk about some of the nuances and what have you, but we hit an all-time high yesterday, and just I've reiterated this a few times over the last couple of weeks, but the first half of July, if we go back to 1928, is the best half of a month, right? And so it usually it's because of the end of the first half of the year, and that's 2 weeks. There's this wall of money that comes in and drives the market up. The average peak in July is the 17th, which was yesterday, and we hit an all-time high yesterday. So it'll be kind of interesting to see going forward. Last year we had a little drop off, start on the 16th of July. So, we're heading into a softer time of the year. August isn't a terrible time. Actually, it does okay. September is, the only month going back to 1928 that actually has a negative for both halves of September. There's some seasonality that plays into this also. Um, all right, so let's talk about some of the things that are really important here. I think this is kind of an interesting chart. Okay, this goes back to the 1800s, and basically this is the average tariff. And this is a little bit dated. It says it's 14.5%. It's actually 18% right now is the average with the newer tariffs. So these charts aren't keeping up with some of the new stuff that's coming along. But I wanted to point this out because I think it's kind of fascinating to me. There's a few things in this chart that are really interesting. Um, Number one is if we go through with the tariffs that we have in place now for August 1st, we will be higher than 20%.
Mhm.
And so it'll be the highest tariffs we've had since we've had income tax. So the high tariffs back in the 1800s and very early 1900s, we didn't have any federal income tax. The federal government kind of gathered its money from tariffs. Over a period of time, people started to realize that you're better off doing a tax and having more free trade, and you'd get more global growth and country growth. And obviously, that's not what we're doing now. And so there's a couple of things that I think are very interesting about this chart. First of all, one of the things that keeps getting talked about is the fact that maybe these tariffs can offset the deficit. Okay, so for example, the projected deficit for this big beautiful bill by the Congressional Budget Office was $3.3 trillion over the next 10 years. And at the current tariff rates, the Yale, budget lab guesstimates maybe $2.7 trillion could come in over the next 10 years. Okay. Look at the chart. Show me where it was up for 10 years, right?
Fortunately, there's no period of time where it's been peaking for a prolonged period of time or
No,
maintaining it.
no, look at there because it's making, little peaks, which is really important in terms of what that means to me. First of all, there is no 10-year period. So why are we bother? I mean, in the history of the tariffs going back to the 1800s, we've never had a 10-year period where we could hold up tariffs at the level that they're at now to get this $2.7 trillion over the next 10 years. They'd have to stay up there. That has never happened. Okay. So the other thing I think that's important and fascinating to me is that high tariffs don't work. Otherwise, they would stay up there, right? You can see a long period of time here where tariffs were low, it went sideways, no problems. But whenever it got really high, it peaks out and comes right back down. If it was working and the government was gathering all this money, they wouldn't bring it down.
Hmm.
So why are they bringing it down? Because it doesn't work, right? And so there's a couple of thought processes that I have about this, and that is very likely that the tariff peaks that we're going into now won't be here for very long. And so that's where the market might be looking, right? I mean, tariffs are only really destruction, can really destroy the economy if they're up there for a while. They certainly contributed to what happened in 1930. The market had already crashed in 1929, and adding tariffs it was an attempt to kind of help. American employment was at unemployment was at 6% at that time. They're trying to protect the job market and keep that number back down, maybe get it down to 4% or something in those lines, and it actually went up to 25% within 18 months.
Hmm.
But that was in a really weak time frame too, so it's kind of interesting to see. But that's the piece on number 1, these tariffs are great. No, they're not. They haven't been, all right? Uh, why would they reduce them like they did in 1930s? We're at 19.8%, and, that starts to come down fairly quickly from there. Every one of these high tariffs are peaks, and the basically comes down from there because there's this understanding that, hey, this is creating other problems that are worse than getting the money. So if we're going to get this 2.7 trillion, but lose, 5 trillion in lost whatever
Yeah.
in the economy, then we're better off having lower tariffs because we can net a higher, revenue to the overall
Yeah. So
government.
the idea is that if these tariffs could cause some sort of recession or demand destruction. And if there's enough demand destruction, those projections of tariffs aren't strong enough to kind of cover the deficit.
Yes. Yes. And these peaking tariffs, if you go back in time and take a look, they had economic repercussions. And so now you have, rate Jamie Dimon, right? Who has the head of JP Morgan Chase. Yeah.
Mhm.
They have unbelievable access to data to see what's happening and what have you. I love listening to people like that because, I mean, unparalleled like data that they have that they can see different trends and what have you. And so what he was talking about this week was private credit. And this relates to tariffs because he talked about even a minor recession, when you have a lot of loans out, can cause a big chunk of those loans to default,
Mhm.
which then creates this kind of cascading effect. And that's what happened. And he talked about that. That's what happened in 2008.
Yeah, essentially, you can only lend mortgages to so many credit-worthy people,
Right.
and so either you have to cut your what your standards are to get more people to generate more business, or you just run out of opportunities. And I think private credit is running that same issue,
Yeah,
is where
exactly.
there's only so many good businesses to buy and invest in and help out.
That's right.
You
That's right.
can't just keep buying.
And then because the money's there and it's sloshing around and you got to get it out the door. That's exactly what happened in 2008, right? They just kept, and pretty soon, lower and lower quality loans were going out for people that couldn't afford that loan, really. And so that's happening very likely in the private credit area. Again, this is all hidden in a way. There is no big exchange to see the private credit. That's coming from this gentleman who has some access to all this. And the way it relates to tariffs, because historically tariffs have caused a slowdown in the economy. And so you're going to get a slowdown in the economy. And that's what I've been saying all along. Maybe Trump can, make that thing a peak and come back down very quickly. I mean, there's some advantages to having one person who can decide versus in 1930, it was the entire Congress had to
Mhm.
decide. It did take a while for that to come back down. But Trump could, see things happening and see the negativity and move back down. But the problem is that, he has to be able to somehow do that before it's too late,
Yeah.
right? And so we've talked about that, and I think that's the biggest reason that we have a third of our stock market exposure not in the stock market, just because those things can happen so rapidly, right? So I wanna keep some powder dry there, as far as that goes. We still I think that's a good balance right now. 2/3 says, "Yes, we're going, the market's gonna continue to go, we might have rate cuts," and we'll talk about some of that here too, towards the end. But anyway, I think that's where tariffs relate. It's just the possibility of slowing things down and something catching, that slowdown in a way that was not expected and turns into something bigger, right? We're coming off a period of cheap money. Usually that means something is out there running around where maybe shouldn't be.
Yeah.
That's what we normally see, right? So then we had the CPI report that came out this week. So this is going back to the 1950s, and this is CPI all the way through, and you can see the big peaks there in 75 and 1980. That was the huge inflation, but you can also see the big peak that we're just coming off of here, in 2022, where CPI got up above 7.5% here. And so if you look at that right now, eh, you know,
It's not bad.
it's not bad, really. I mean, look at where it is right now. It spent a ton of time in that same range for a really long time, from 1982 to all the way through to to the 2022 thing. And so uh, tonight we're at 2.7%, right? The CPI is the growth. However, the market dropped on this particular report this week, and a couple of things. Number one, if you look at it month over month, right? So here's the last 12 months. You can see April, and it was kind of a low point there, and then now May it's coming up, and June it's coming up. So June was 0.3% higher, right, than May.
Yeah, they were thinking that the expectation was 2.6.
Yeah, but which is fine. It's higher, right? So it's going the wrong direction. However, if you look closely at this chart, you'll see that it went up all the way from September to January of this, last year to this year. And so that had nothing to do with tariffs or, that just happens. There is a volatility in these numbers that just comes along. And so, you look at that again, historically, long term, you look at that in the last 12 months, because we've had a lot of times where CPI has gone up and then eventually it just kind of fell back down over the last couple of, years, and it's been slowly working its way down. However, if you really dig behind the scenes and you take a look, this is what people were worried about. And this is the tariff related sectors. And there's more, I just got a few here. So again, the overall price increase for June was 0.3%.
Mhm.
That annualizes out to 3.6, which is a lot higher than 2.7, which is what we did the last 12 months. So again, there's some push there, but like volatility on the monthly numbers happen all the time. However, household furnishings are actually up 1%, almost three times, a little bit more than three times higher than the overall average. And inside of that are some really big ones. So window and floor coverings up 4.2%, which is a record. That's for 1 month. Okay.
Yeah, and these are a lot of the ones that have exposure to tariffs.
Yep, that's exactly right. And so that's, because they're being imported. Appliances up 1.9%, again, just for the month. Recreational goods overall, significantly higher inflation for the month than the average at 0.8. But if you look inside that, there's some big ones. Audio and video equipment up 1.1, sporting goods 1.4, toys up 1.7, and then apparel, I'm sorry, toys 1.8, apparel's up 1.7. So again, these are things this is what the market's worried about, right? You're gonna see these segments, that really drive things. Now, overall, you can see CPI still doing okay if some of the other areas continue to soften, right?
Yeah, so shelter,
Mhm.
which has been very sticky, is starting to soften. Um, Other stuff like hotels are softening too. So you can see other sectors kind of softening, where you can see maybe it's also a tightening of the belt of the consumer too.
Yeah, exactly. They did have retail sales that came out for the week, and it was quite good. Although they did attribute a big chunk of the gain to the actual increased cost of those goods, but consumers still out there spending, and I think again, I've been saying this for a while. The irony of these tariffs is that they've actually helped things. First time unemployment claims came through this week. They were down again for the fifth time in a row. Still 221,000, so not, really low, but still, not bad in a normal overall course of things. You have this, situation with retail sales doing well. And again, I think, it's driving people to buy stuff, right? Because if I look at that and I know that I need window floor coverings and I just see it's grew 4.2%, it could grow a lot more. I might go out and get my window floor coverings early for my project
Hmm.
when I'm building a house,
Yeah.
if I'm a contractor, whatever it is, right? If I'm building homes right now, I'm gonna go out and try to buy some stuff now, right? Because I see these numbers, and so that makes things look great until the other side hits. Because a lot of that stuff can be front end loaded, might have been purchased maybe in the fall, that's not gonna be purchased in the fall, right? Because it was purchased now.
Yeah, and if the prices go up enough, there's going to just be a demand destruction that where
Yep.
people stop buying.
Yep, that's right. And so that's where, you see some of the uncertainty that's out there and what have you, kind of combining with this whole situation of, what's behind the scenes. Okay, so then the last thing we'll talk about really is just Chairman Powell, because that was a big piece of this week also. So there was a report that came out that an insider in the White House said that Chairman Powell's, firing was going to happen.
Mhm.
There was a letter that had been prepared and all these things. The market dropped about 0.7% pretty much immediately. And then the bond market actually dropped also. So the yield started going up. There's a chart of the 30-year yield, which is the most sensitive one, but it went up quite drastically, with that, I guess we'll call it a rumor as far as that goes. And then Trump was asked directly about it, and he said, "No, no, we're not gonna do that." right? And the market kind of came back around. It still ended up slightly down for the day, but nothing like it was. So, but this is an ongoing thing, and so this is. I think this is going to be kind of important. Uh, there's a couple of areas. First of all, it's never happened. The irony of it, in my opinion, is you fire the Federal Reserve Chairman to try to get somebody in there to lower rates. Okay, they can only lower one rate, and that's assuming they can get the board to go along. After you
Mhm,
just fired the chairman, you still have the board. They still have to agree on this rate cut. And so let's say that they are able to do this rate cut. Well, the market is going to have already chosen a situation where, hey, for the first time, I think in history, a Fed Reserve governor was interfered with to the point of being fired, and the U.S. would start to see less trust coming across the
mhm,
whole basis, and yields would actually go up. Okay, so borrowing costs would go up in that environment, even if they were trying to lower the Fed funds rate, because the Fed funds rate is only the amount that they charge to large banks, and so the market sets the rest. Now, usually that follows the Fed funds rate,
mhm.
but if you just fired the Federal Reserve Chairman, you're probably going to see a situation where borrowing costs go up. He's going to get exactly the opposite of what he
Yeah,
was.
the foreign investors or just a general investor doesn't like when someone interferes with the rates. They
Right.
don't like political interference.
Yeah, exactly, and that's why it's supposed to be independent. It's why it's the gold standard. It's a big piece of, this whole what we're doing here, unfortunately, is we're kind of taking away probably one of the most important things the U.S. has, which is this safety aspect. So when everything's falling apart, people go to the U.S., they go to the dollar, they go to treasuries, right? And we're starting to see some of that erode with the tariff policies. It's kind of the anger around those, and the situation of firing the Fed, I think, would just fan those flames as far as that goes. So. Um, I think it would be a really bad thing to do. The market might recover from it. The bond market might really have trouble with it in the end because that's where the rates are set. Um, so anyway, that was a piece of what happened this week. We'll see. I wouldn't be surprised to. I at this point in time, they keep talking about, oh, we'll be able to change out anyway in May. I don't know. It's coming on so strongly all the time. How do we get to May?
Usually,
That's a
where
long ways off.
there's smoke, there's a fire, and
Yeah,
so
yeah,
I
yeah.
think it could be just using this as a testing of the waters.
Yeah, I will say though, in the end, even if they don't, fire Powell before May, they will get to put somebody in there who's going to want to cut rates pretty heavily. So that'll be pretty. That could be good, I suppose. You know, tariffs can slow down the economy. They have in the past, and so cutting rates in advance of that slowdown could be a good thing. It could cause inflation. Ray Alioto, a hedge fund manager, has been running around talking about, how the Fed needs to stay independent and that the risk is this lowering of rates and then creating kind of this hyperinflation. But you can't get inflation on a normal basis if the economy's weak. In other
Mhm,
words, if consumers are confused and don't know, the uncertainty is too high, and you start to stop spending because things are getting too expensive. Um, it ironically you still have prices going up because of the tariffs, but it won't be because of lower interest rates,
mhm.
right? So I don't know. I do feel like there might be some room to do some lowering of interest rates here because I think the economy is going to start to slow down. But the Fed has said that they want to see hard data first. Um, boy, probably going to be too late. I bet you the recession is already kind of happening, and then that brings into play some of these other potential risks.
Yeah, I think the Fed is very cognizant of the 80s and the basically
Yes,
inflation's
yes,
running wild again after they've tried to tame it. So
yep.
they're really going to, they rather have recession than.
But this is different in a way. That was energy driven, in that 7-year period, oil went from $4 to $40 a barrel, right? Which is unbelievable, 10 times the cost for a barrel of oil. And this is tariff driven. So what the Fed would be concerned about is kind of that supply and demand. So if demand is dropping down, even though prices are going up because of tariffs, if demand is coming down because of the softness and all the other things we talked about, you can lower rates into that situation and not have the traditional inflation,
Mhm.
which is supply and demand, where the demand shifts way up, um, potentially. I mean, I that's why I do think there's room for a couple of rate cuts. And September's now up to 57%. This week it got down to 52% chance of a rate cut. But we saw, 70%, a little bit more than a week ago. So, the CPI report kind of some of the things I pointed out there. Basically, you're starting to see some, concerns in that particular market. So anyway, that's what we have for this week. There's a lot going on, a lot happening, a week by week basis. So, we'll keep talking about it and appreciate everybody kind of listening to the summary.